Hi, everyone. Welcome and thank you for joining us today for a special edition of our VC Ask Me Anything at Next. My name is Ryan KisKis. I lead our work with the venture capital and startup ecosystem for Google Cloud globally. Our VC AMA series is a monthly digital event hosted by Google for startups. And for the startup and investment ecosystem to come together, give investors a platform to share trends, themes, theses that drive their investment decisions and the opportunities that they see, and also a chance for our startups to connect with them directly. Today, we got 20 minutes of Q&A with our VC guest, Dharmesh Thakker, general partner at Battery Ventures. We've held a number of AMAs globally, and we're thrilled to have Dharmesh join us today for Next as our flagship event for Google Cloud to connect with our customers. Dharmesh joined Battery in 2015 to focus on early stage and growth equity investments in areas including cloud infrastructure, big data, security, next generation enterprise applications. Before joining Battery, he was a managing director at Intel Capital, where he led the firm's global cloud and big data practice and made early and later stage investments in companies globally. Dharmesh has almost spent a decade in product management and go-to-market roles with enterprise software companies like Keynote Systems, Manhattan Associates, and two other startups leading to their acquisitions. In 2016, Dharmesh was named to the Forbes Midas Brink list of up-and-coming VCs, and in 2018, he was included on Business Insider's 23 top venture capitalists in enterprise tech. Dharmesh is a prolific blogger on cloud-native topics, and you can find him on TechCrunch, Forbes, and Battery Ventures podcast, Billion Dollar B2B. Dharmesh, thanks for joining us today.
Thank you, Ryan. It's great to be here. I hope I don't disappoint.
I am sure you will not. It's actually great to have you. Um, So your specialization is in cloud, and that's one that's very fitting for us today as this talk is part of Google Cloud's next event. Seeing that you've been involved in cloud infrastructure, data, and security for a number of years, I think you're going to have a lot of great insights to share with the community here. I wonder if you could give us a bit of background. Can you share a bit about your path to Battery?
Sure. My path to battery had a lot of twists and turns, not that different than many founders' paths to success. I'm an engineer by training. I was the first person in my family to finish high school, so didn't have a lot of career advice along the way. So I tried a lot of things, made mistakes, and learned along the way. The one thing I knew when I graduated back in '99 in the dot-com era is I wanted to go build something and be part of the technology cycle, the technology industry. So I tried my hand at semiconductors, did a couple of internships at Intel, Texas Instruments, then tried my hand at supply chain, and eventually found my way to web software back in 2000 in Silicon Valley, and really enjoyed the product management side of things, connecting the dots between technology and what customers wanted. And that took me on my decade-long career, two startups and two public companies. It's a great journey, joining a public company, see it go to multi-billion valuation in the dot-com era, to see it almost go to zero and then survive over the next decade. So a lot of lessons along the way. And then eventually, when I graduated business school, I wanted to go do my own startup again, but couldn't quite figure out back in 2008, whether I want to go jump on the mobile bandwagon, the cloud bandwagon. And so I spent some time at one of the VCs that had backed my company and fell in love with the job. It's a great opportunity for me to not put all my eggs in one basket, but help a handful of companies with figuring out their product market fit, help them scale. And I've been very fortunate to be part of the journey with many companies like Mongo, like Cloudera, like Databricks over the years, which eventually led me to Battery back in 2015. It was a once in a lifetime opportunity to take a fund that had been around for 35 years then, and be a part of kind of building out the infrastructure practice for Battery. And so here I am. We're now in our 39th year on a 14th fund, managing roughly 20 billion, and I'm in the fortunate position to go help build out our enterprise software practice.
Such a such a great journey, and there's so much. It's like adaptability along the way to figure out kind of what's interesting, where do you want to put that time and attention. I mean, Battery is one of the institutions of the space. Like I've looked up to Battery my entire career here. You operate globally. You've got 14 flagship funds. Yet over that time, the entire software and internet ecosystem has evolved dramatically. You've got to adapt your focus. You've got to adapt your theses to what the current market is. I wonder if you could share a little bit about what some of your current concentration areas are and how those came about. Like how are you looking at the space now to figure out where you want to put your time and investments?
Yeah, no, absolutely. So, Battery, we made a conscious decision to be domain centric, but stage and geo agnostic. So early on in the fund's founding, we said, hey, software is an area that will transform multiple industries. And we decided to major in software, both application and infrastructure. But within that, we said, hey, there's going to be great companies starting not just in Silicon Valley, but in Boston and New York and Europe and Israel, which has really played out. So we've always kind of had a global footprint, trying to find companies from seed stage all the way to IPO across US, Europe, and Israel, but focus on the software arena. And within that, I spend most of my time on the infrastructure space where a lot has evolved. Over the last decade or so, you've seen Google, Amazon, Microsoft build $100 billion cloud franchise, which is just starting. We've seen big data applications. Cybersecurity is an evergreen area given all the threats and challenges out there. So, anything that caters to a technical audience in that data security cloud area is kind of what I focus on. And through my team of 10 plus individuals across Israel, across Europe, New York, and Silicon Valley, we try to find the best companies, whether it's a company like Gong in Israel at an early stage, or a company like Databricks at a growth stage, or incubating a company within our offices. So that's my area of focus. And as you said, we got to adapt to the industry. Over the last decade, we've certainly seen lots of ups and downs. We in my career, I've seen 2001, 2008. We saw the slowdown in 2020, and more recently, the slowdown we have now. And every boom cycle has been an opportunity to grow the business and accumulate a strong balance sheet. And every down cycle has been an amazing opportunity to hire some incredible talent and improve your competitive position. So, as long as you're willing to accept that there will be ups and downs and you're ready for the ups and downs, you can build a great company along the way and be much more resilient through the ups and downs. And so we try to bring that discipline to many of our portfolio companies in that cloud data and security space. And I think it's made us stronger as a firm and as a portfolio.
Yeah. I mean, let's pick up on that for a minute. I mean, you've had the chance to see some of these ups and downs, as you said, and work super closely with some of the the best founders in the industry. I'm wondering if you could share some of the best practices you've seen from some of those early stage founders that they've implemented. How are they thinking about building their companies around infrastructure, security, data?
Yeah, if I think about like what I look in early stage founders and what I found, you know, characteristics of strong founders at an early stage, I'd say like three core things come to mind. One, I think they're incredibly customer focused, customer obsessed, even, right? Where many technical founders will build incredible features in a platform, but that's very different than what a customer wants. You're trying to solve a customer problem, and that's a product. And a product is not the same as technology and features. So great early stage founders are able to simplify the features and their platform into bite-sized products that solve problems and customers are willing to pay. So that customer obsession, what we call product market fit, achieving that early in the cycle requires a lot of iterations, a lot of experiments, rapid experiments, and living with uncertainty. And great founders are very, very, very comfortable with that uncertainty and really figuring out product market fit. And you achieved it when you see 10, 20 customers with the same persona buying it for the same reason. And that's when you achieve product market fit, and then you can scale the business. So that's the first characteristic we'll look for in a Series A company, where they have early product market fit and a founder who has that experimentation mindset and is comfortable with uncertainty, right? Uh, the second thing I see, which is equally important, is they don't look at a head fake like a huge community of open source users or like friendly design wins. They don't confuse popularity with profitability. They know that just because you're popular, that just translates into free usage. That's not enough to figure out product market fit. What problem are you solving that somebody is willing to pay for? So focusing on customer needs and avoiding the head fakes, and until you figure that out, you don't scale the business. That's, I think, two core characteristics of founders at the early stage. And then third, and perhaps most important, is hiring great people. Great founders are always looking for great people. And that doesn't always just mean folks with an incredible resume. Often, folks with an incredible resume may happen to be at the right place at the right time. Doesn't necessarily mean that they're comfortable building and they're hustlers, right? So, finding people at an early stage who are, they're doers, not just managers, who are driven to go build a company, not just kind of go build a team and delegate everything. And finding those great people at the early stage is critical. but the job's never done. Folks that take the company from 0 to 50 are different than the folks that take it from 50 to 100. So founders are probably spending half their time figuring out individual team members as well as the chemistry between the team and constantly looking for the right people. So those are some of the characteristics I look for at an early stage. And as a business grows, of course, you look for pipeline and coverage and quota carrying capacity. That's a bit more mechanical. But generally, if you're in a good market with some urgency and you can be customer obsessed, avoid the head fakes, and build a great team, that foundation will take you a long way. At Databricks, I think the first 20 people and the first 10 customers told them so much about the product market fit that it made the scaling from 0 to 100, 100 to a billion much easier because they spent all that time upfront figuring out the right product market fit with the right repeatability. So that's kind of what we look for.
Makes sense. Tons of sense. And as you've seen this, you've seen these patterns of successful founders in your portfolio, the ones you've worked with. One of the best ways for you to bring that expertise to the next generation of founders, the early stage companies, is through your participation in boards. And you sit on a lot of boards. Startups are going to be lucky to have you on there. I'm wondering if you could share a bit in your thoughts on startup boards, like how do they best operate? How do you best bring value, and maybe how that evolves, as you said, through the company's evolution.
Yeah, I know that's very kind of you to say. Look, so I think the value is somewhat different at kind of later stages, but because we spend most of our time on Series A, Series B companies, I'll kind of start with that. I think the role of a good board is to really ask the right questions for the founder and the executive team to do some soul searching and figure out the answers. Right? I was in a board meeting this morning, and we have huge pipeline, and yet our quota attainment is like dropping. And what exactly is going on? So asking the early stage founder who needs this, why do they need it, why can't they live without it, where does the budget come from? It's a very powerful questions that often technical founders don't think about. They think about building an incredible product with features, and customers should just love it and they should be buying it all over the place. But often when that doesn't happen, the role of a board is to ask them those probing questions that makes them think about the solution. On the contrary, going to a board meeting and telling the CEO how to run the company is a fairly counterproductive board meeting. I try to avoid going to board meetings and saying, "Hey, listen, here's what you should do to fix it. Here's what you should do to fix it." And a good CEO should just tell you, "Well, I'm in the hot seat. If you want to fix it, you do it." So I don't think going to a board meeting and telling founders how to run the business is a productive kind of discussion. But asking them probing questions that makes them think. Secondly, giving them the resources that can help them along the way. The biggest benefit a VC can bring is the years of expertise and the mistakes others have made along the way. So your next company doesn't have to make the same mistake. So one of the areas I try to help, my companies that are often in open source or dealing with cloud marketplaces like GCP, for instance, is to pair them up with resources that have been there, done that before, so they can learn with them. And I'm really the matchmaker, helping a company that's going 0 to 10 learn from somebody who's going from 100 to a billion, who's been through that journey before. So I think those are a couple of the characteristics that help founders at an early stage. And once companies get to 10, 20 million, and tens of customers, that path from 20 to 100 is very people oriented. Hiring a good VP of sales, a CRO, a CMO. That's where board members can go effectively sell the vision of the company to hire great people and go help with the team building at the mid growth at the mid stage. And then finally, as a company prepares to go public, figuring out how to think about the IPO process. Often companies are in a rush to go public as opposed to building consistency and predictability in the business. So often you got to slow down to speed up and get a few quarters of beat and raise patterns under your belt. So at the IPO stage, and providing that guidance on when to go public, how to think about the timing and consistency, as opposed to rushing to go out, is a different set of value add that you provide at that stage. So that's kind of how I think about this cycle. And there's a number of good people in the industry that I love to work with, where we roll our sleeves together and help our companies along the way.
It's great to see you active alongside of those founders and those leadership teams. Such a great value to have that expertise you can bring to them along the way as well. Um, I wonder if we could, you make a lot of your investments in data, AI, this landscape is changing incredibly rapidly. And I wonder if you could share something you've seen maybe from one of your portfolio companies do lately in this rapidly changing space, and maybe surprised you, kind of blew you away. I was like, that's great. And any anecdotes like that you might be able to share with us today.
Yeah, there's a handful, but like the one that comes to mind is kind of top of mind. I mean, the number one issue an investor has for companies that are in massive markets is like, why aren't you growing fast enough? And in sales, there's this perpetual issue of like, how do you train reps to ramp them up in 6 months as opposed to 12 months? How do you achieve quota uniformly? And one of the most powerful signals you get is a customer conversation. So we happen to be fortunate to invest in a company called Gong, and they have this magical product that when I saw it for the first time I was blown away, where you can analyze a voice conversation between a customer and a rep, pick out the signals that are directly correlated to winning that deal or what messages made the customer convert, use that to train your reps, use that to create better forecasting, use that to avoid kind of mistakes that kind of could result to churn. And like just a simple kind of analysis of voice conversations and just in time probing of the reps, the sales reps, was instrumental in improving their productivity, improving their attainment, and it was magical. I mean, that led us to going investing in the company. And now, as a firm, we look at many of the same customer calls as part of our diligence to say, how do customers feel about this product? So, in many ways, it's simple analysis of conversations, and yet the insights we get are so powerful that it impacts thousands of companies that are in the tech industry. For instance, 60% of revenue in software companies is spent on sales and marketing. If you can nudge that 5 percentage points in a $2.5 trillion IT spending industry, I mean, the impact could be profound. So that's just like one example that is like top of mind, which we see in many of our companies where Gong is providing that insight to drive better customer conversations and better sales productivity. Uh, that's in the work world. I mean, in my personal life, I'm fascinated at how my Tesla just drives me to work and gets on autopilot mode, so I can do my email along the way, which I wouldn't recommend, but sometimes I end up doing it anyway. But there's so many examples of and using conversation data, image data, and kind of in our daily life that makes us so much more productive and efficient.
Yeah, it's I love both of those stories. um, drive safely, everyone. Um, um, so I mean, you mentioned the turns, the ups and downs that startup world goes through, and we're obviously in one of those certainly uncertain times. Maybe down. Maybe who knows where it goes. But given the current market, given the current environment, I'm wondering how you might see the way companies change their funding, change their fundraising in the next few months. How do they need to adapt now? How do they look ahead, maybe a year or 5 years down the line? Are there things you're seeing happen now that might have a trailing impact for them?
Yeah, I think well, first and foremost, I might be drinking my own Kool-Aid, but I feel like if you zoom out, there's never been a better time to be in this whole cloud software industry, right? So despite all the macro talk about interest rates and multiples, what we forget sometimes to look at is there are more companies now that are at 1 to 5 billion in revenue, growing 50% plus than there have ever been, right? And Google, Amazon, Azure collectively are like 100 billion, still growing 40% because this market is so massive. So if we think about companies that are in the cloud software arena, I think the future is fairly bright because there's still another 600-700 billion dollars of legacy software that is waiting to be disrupted. And so we feel very good about investing in this space. And even if this environment of high inflation kind of sustains, cloud could be a deflationary factor. When a company has to cut down costs to manage or to cut down their personnel to manage their cost structure, they end up using more software to drive productivity. So we generally feel bullish about the cloud software space and feel like the rate of financings in that space will continue. The valuations may adjust, but the rate of financings will still be fairly healthy. Now, in terms of what founders are doing differently now versus a couple of years ago, I feel like it's a return back to normal. In many ways, you don't see the 100x forward ARR multiple that you saw in 2020 and 21. Uh, that was kind of this blip where things just spiked up. And if you look at it, we're now back to the long-term average of 10, 20 times forward revenue multiples for healthy companies growing 50, 60%. So I don't think it's a bad place to be, but I think it's a good place where founders will raise the amount of money that's necessary to build the business, as opposed to raising a bunch of money just to feel good. Sometimes raising too much money can give you a false sense of security because you out executed your competitor. They raise 100 million at a billion. I raised 200 million at 2 billion. What are you going to use it for? It's a loan with a preferred rate that you're going to have to pay back someday. So do you really need to raise 200 million when you barely have a million in revenue? So I think a lot of the fundamental questions that founders should be asking themselves that they, kind of walked away from the last couple of years are coming back to the picture. You're seeing founders focus on the right kind of raise, healthy valuation, but most importantly, pick investors and partners that can help them along the way. It was pretty easy the last couple of years to show up on a Zoom call, talk to an investor, have the money wired in 2 weeks, and nobody ever joins your board. Good luck. Um, but as we've talked about, there's a lot of ups and downs along the way of building a company. Picking the right partner who can ask you probing questions, provide you support, be part of the journey from 0 to 100 million and beyond is absolutely critical, perhaps even more critical than just purely the valuation of the company. So I think there's a return to fundamentals. Uh, Fundraising is healthy, but founders are focusing a lot more on picking the right partner who can help them along the way, and raising money at reasonable valuations, which gives them a step up to raise the next round and the next round after that at step ups, which is frankly very healthy for founders, investors, and their employees.
Yeah. Yeah, it's definitely an interesting time right now, and I think there's been incredible companies that get founded out of every one of these downturns, right? That have to ask those harder questions and put themselves in a really great position for the future.
Yeah, some of the best companies of our generation, they were started back in the 2008, 9, 10 arena where, you had engineers at large companies that were willing to take a shot because the large companies stopped innovating or they're laying off people, and you wanted to go work on something new. So I think it's a really healthy time. The quality of employees that we're able to hire right now from overinflated unicorns or public companies where their stocks are down 80%, we have this, flood of very high quality engineers, salespeople, marketing folks that are willing to join Series A, Series B companies that are reasonable valuation, because reasonable valuation translates to significantly more upside and a chance to go build the company the right way, as opposed to living up to some unrealistic valuation.
Yeah. All right. I want to move us to our lightning round. Staying or fading. So, is this something you think is going to stick around, be part of the ecosystem for a while, or fading? Not as popular. So, I'll kick us off with video conference fundraising.
I think it's staying, but at the later stages, you better be meeting your partners if you're going to get married with them for 10 years. You don't want to do that on Zoom.
Makes sense. How about remote work?
It's staying. I mean, it's a hybrid mode. I see most companies go back 2, 3 days a week, but it's definitely staying.
Utilizing your personal network for fundraising.
I think there's value in good old networking and using that to find the right partner. So I think it's staying.
Makes sense. Web3, blockchain, this whole space.
It's definitely happening. I mean, it's not here yet, but it's happening.
How about Web2?
You got enterprises that need to make a living, so Web 2 is going to be here for a while until Web 3 takes off.
How about everything will be in the cloud?
Aren't we there already?
Working on it every day, a little bit more. All right, closing us out. What's one piece of advice you'd have for a founder just starting out on their journey today?
One piece of advice, so much more to offer. The one piece of advice I'd say is, hire hustlers, not just great resumes, right? In this era, you are going to find first-time founders and employees who are not wedded to the past and have a fresh way of doing things in the future. Um, Find those people who are driven for the right reasons, they're hustling and they're delivering, not just folks who happen to have great resumes. You find great people, good things will happen.
Dharmesh, it's been an absolute pleasure talking to you today. Thank you, everyone, for joining us in this special edition of our VCAMA series for Next. I'm always energized by these conversations with VCs and, the chance for all of you in the audience today to learn from some of Dharmesh's knowledge and what he can help bring to the future of your company as well. Thanks, everyone, and enjoy the rest of the event.
Thank you for having me.